In this section of the lecture, I'm going to be talking about two economic crises that affected the Asian economies. The first, a crisis really concentrated in Japan that began in the 1980s, but has really affected its economic performance through to the present day. The second crisis, a more concentrated crisis known as the Asian financial crisis that happened in the 1990s. I'm going to start out by talking about the Japanese episode and then go on to talk about the Asian financial crisis. One sort of aside on talking about these crises is that it's often the case that popular accounts of economic development single out whatever country happens to be developing most rapidly at the time and make that what I've called here the poster child for economic development. And that was certainly the case in Japan in the 1970s and 1980s. There are a large number of popular accounts about the Japanese economy, books that had titles like Asia's New Giant, Japan as Number One, The Emerging Japanese Superstate, that did things like forecast when it would be that Japan would overtake the United States as the world's leading economy, and tried to mine the experience of Japanese economic development to find out, as I described in the last section of the lecture, what was the secret X factor that the Japanese economy was doing that other economies should be imitating, or what was the particular policy approaches that the Japanese government had applied that governments in other countries should be adopting. As I've suggested with the title to this overhead, being the poster child for economic development is often, unfortunately, a good predictor of when an economy is about to go into decline. And certainly that was the case with the Japanese economy, that as books on the Japanese economy in the West reached a crescendo in the 1980s, a crash was building up in the Japanese economy. How does what I'm calling the crash in the Japanese economy happen? Well, the origins of this crash were in substantial asset price inflation, which was occurring in the Japanese economy, especially in property. So by asset price inflation, what we mean is just very high rates of increase in prices, and here especially in property. And that was due to two things. First of all, in Japan, high levels of urbanization with restrictions on the supply of land, and secondly, increased leverage or borrowing based on high property prices and high share prices, both in the household but also particularly in the corporate sector. So the corporate sector in Japan was notable for its high levels of ownership of property and shares. And so what companies were doing was borrowing on the basis of the collateral of the property they owned and their shares, and using that, for example, to buy extra property, which would then force up the price of property more. That would increase their capacity, the capacity of those companies to borrow, because they held property and the price that it was going, so they could then borrow more because they had more collateral. And so in that sense, as I've described here, the increased leverage which existed in the Japanese economy became self-perpetuating, because there was borrowing. That borrowing was being used to finance purchases, for example, of property and shares. That would increase their prices. If those were being held as collateral, that increase in their value would then become the basis for more borrowing. So there was asset price inflation in the Japanese economy. This table gives you a bit of a perspective on the extent to which borrowing was coming to be increasingly directed towards real estate in the Japanese economy, especially during the 1980s. So this is the average annual rate of growth in bank lending in Japan. So I've got a column which is the total, sort of 9%, 11%, 11%. And you can see, so manufacturing lending, it's growing a bit in the late 70s, early 80s. But in the second part of the 80s, basically no growth in bank lending to manufacturing, but instead huge rates of growth in bank lending for real estate. So there's a lot of borrowing that's being directed primarily towards purchasing real estate, which is increasing the price of real estate in Japan. Now, this growth in borrowing is sustainable as long as several factors are in place. One factor is high rates of GDP growth. So as long as the economy is still growing, as long as firms' business operations are growing, then that provides, growing strongly, that provides a basis for them to be making repayments on the borrowing that they're doing. But of course, as we've seen in the earlier section on Japan in post-World War II, post-1973, growth begins to slow. And so that means the capacity to be financing borrowing begins to slow as well. Secondly, borrowing is facilitated by low interest rates. So there's relatively low interest rates in Japan up until the mid-1980s. That's because Japan's maintained strong controls against international capital flows. So basically, if you're saving money to invest in Japan, there are big restrictions on investing that offshore. You have to invest it in Japan, and so that means that Japanese policymakers can keep interest rates low and still attract high levels of saving because they don't have to worry about those savings being competed away, moving offshore. But in the mid-1980s, these controls are substantially liberalised, and so that gives people saving in Japan the capacity to earn higher rates of interest by investing their money internationally. And that starts to happen from the mid-1980s, and that means that interest rates in Japan are going to start rising, which puts pressure on organisations and individuals who've borrowed money. Third factor is easy monetary policy. So during the 1980s, Japan, for several reasons, has had relatively easy monetary policy, increasing money supply, and as we saw on the previous table, that has allowed very high rates of growth in bank loans to real estate. But that easy monetary policy is reversed in the late 1980s. So once Japan takes off its restrictions on capital flows and investors start increasingly investing overseas and there's this capital outflow, then the Japanese central bank is concerned about all that capital outflow, and so it reacts to try and reduce the capital outflow by having a more restrictive monetary policy and increasing interest rates. And so again, that increase in interest rates, more restrictive monetary policy, reduces the capacity of borrowers to be financing and repaying their borrowers. So essentially what happens is there's a variety of structural factors which allowed increased borrowing to be occurring in the period up to the mid-1980s, but those structural factors reverse gradually in the case of slowing growth, more suddenly in the case of changing capital controls and monetary policy. And what happens is when those structural factors reverse, it means that the asset, the bidding up of the prices of assets by increased borrowing, which has been going on, that process stops. There's no longer the scope to be continuing to increase borrowing to underpin these increasing prices. Instead, the process reverses, and that means that the asset price inflation which has been occurring is also reversed. And Japan experiences both stock market and property market crashes. In this graph, I've got data for share prices in Japan, the Nikkei 225 index from 1984 to 2013. And so you can see a crash in share prices here occurring around about 1988, 89. And the crash when it occurs is substantial. The index had reached almost 4,000 at its peak, and it falls away over a period of a couple of years to be at 1,500. So more than halving of the share price index. And you can see that basically the index hasn't recovered to the levels that it was at in the mid to late 1980s, an indicator of what we'll talk about shortly in this section of the lecture, which has been how this crash really was the forerunner of a period of much slower economic growth in Japan. In this graph, I've got the average urban land price in 6 major cities in Japan. And so you can see that this index, for example, it's back at about 50 in 1974, it's at 100 in 1986, it increases to almost 300 by the early 1990s, and then you can see basically then falls away. By 1994, it's gone from 300 to 200. By the late 1990s, it's down to 100. And like the share price index, has never recovered to be at the same level that it was at back at its peak in the share price index case, the late 1980s, here in the early 1990s. So there's a very significant disturbance to asset prices, share prices, more than halving, land prices. You can see basically within several years, halving or almost reduced by a third in value. And as I just mentioned, this is really the forerunner of a period of much slower economic growth in Japan. Firstly, this crash in prices has substantial adverse effects on the Japanese economy. So the crash in prices mean that a lot of organisations that have borrowed money from banks can't repay their loans, 25% of bad debts. So the banking sector is in crisis and really has a significantly reduced capacity to play a role in the economy through, for example, lending. Another problem is that the organisations, the corporations who have borrowed these funds, once the price of the assets that they've been purchasing with the borrowed funds, the shares and the land, decrease so much, then they are in the red on their balance sheet. So they hold these assets that are worth a lot less than they were before. And so they move into positions of debt. And what happens in Japan in the 1990s is that a lot of these corporations seek to pay off those debts before engaging in borrowing or new investment activity, a situation that Keynes referred to as a liquidity trap. The companies, no matter how low the central bank might make interest rates, the companies aren't interested in borrowing. They have this other objective of getting themselves back into the black by paying off their debts. And of course, there were individual households who own shares, who own property, whose wealth is significantly reduced by this asset price crashes, and so that then has an adverse effect on their consumption spending during this period. So the crash in prices really brings a reduction in investment, consumption, banking activity in the Japanese economy. There are also other structural influences which feed into this downturn in the Japanese economy. So one factor which I've already talked about a little bit was the idea that the Japanese had taken off restrictions on capital outflows in the mid-1980s. And so this means that throughout this period there's a long-run influence of capital outflow reducing economic activity in Japan. And policymakers in Japan really sort of face a two-edged sword. On the one hand, they can try and decrease interest rates to stimulate economic activity, but if they do that, they increase the differential between what investors can get by investing money overseas versus in Japan. So they increase capital outflow. Versus if they increase interest rates, that may stop capital outflow to some degree, but it may reduce incentives to engage in investment activity by corporations in Japan. Secondly, demography, which had been a positive for the Japanese economy throughout the period from World War II up to the 70s and 80s, becomes a negative. So there's a decreasing proportion of the population who are in the workforce, and the ageing population means that domestic savings rates the high level of which had been a major positive factor in Japanese economic development, domestic savings rates become much lower than they had been. So the ageing population has a double effect in adversely affecting economic development in Japan. There's a deterioration in public finance in Japan. So as the Japanese government seeks to stimulate the economy using fiscal or budget policy during the 1990s and 2000s, they increasingly develop a large public debt. So as I've noted here, percentage of debt in GDP increases from 85% in the mid-1990s to 200% in 2010. So this public, the debt that the Japanese government has, that becomes a brake on the extent to which the Japanese government sees itself as being able to stimulate the economy as we move through to the present. Also, arguably Japan has diminishing comparative advantage in the area of manufacturing, and we see the Japanese economy start to deindustrialise. And increasingly economic activity moves towards the service sector, where it seems that Japan is not as strong a performer as it is in the area of manufacturing industry. So, for example, the percent of GDP in industry in Japan falls from 35 to 25% from 1990 to 2010. So industry is no longer the driver of economic activity in Japan that it was in the halcyon period from World War II through to the 1970s and 1980s. And in fact, industry output only increases by 4% during this period. The other issue is the service sector, and so where do workers who aren't being employed in industry go now? It's not back to agriculture, it's into the service sector. And so a problem for Japan is that it is not as efficient a service sector producer as it is a manufacturing industry producer. And Raghuram Rajan in his book Fault Lines talks about inefficiency of service sector in the Asian economies where government had played a strong role in trying to stimulate industry. He says, although global competition limited the deleterious effects of government intervention in the export sector, industry, there were no such restraints in the domestic-oriented production sector. As a result, these sectors are very inefficient. So he's saying, look, these countries such as Japan adopted arrangements to promote industry that did not lead to inefficiencies in terms of production by industry because there was the check of international competition. But when we think about the service sector, which is producing to a large degree or had been producing to a large degree for domestic production, that same hand of government on economic activity promoted inefficiencies.